Hi, everyone. We have a packed session here today, which is pretty exciting. And our guest today is Stephanie Singer from Morse, a great law firm here in the greater Boston area. So, and those of you who were at the last webinar, you know that this is probably one of the most important sessions you're going to have access to in terms of her legal skills, because Stephanie is really one of the leading experts in this area. So get your questions ready. So here we are. Stephanie Singer with Morse, a law firm here in the greater Boston area, talking about safes and convertible notes. Let me tell you a little bit about Stephanie. She is a highly recognized attorney serving entrepreneurs, startups, and high-growth companies throughout the life cycle. She's represented a wide range of technology and life sciences companies on formation, equity-related matters, M&A, and ongoing corporate matters. In addition, she represents VC funds in making portfolio investments. She has considerable experience with public offerings, public company counseling, and fund formation. She's a part-time faculty at Boston University School of Law, where she teaches a transaction simulation class focused on venture capital financing. And most notably, a Harvard Law School grad. She was editor-in-chief of the Harvard Negotiation Law Review and named a rising star by the Massachusetts Super Lawyers in 2018. So, welcome, Stephanie. We are very fortunate to have you.
Thanks, Virginia. Thank you for that nice introduction. And if you'll bear with me, I'm just gonna share my screen so we can get started talking today about raising capital through convertible securities. We'll focus on notes and on convertible debt. So let me share my screen.
And before you start, Stephanie, I just want to remind everybody, we had quite a few questions submitted ahead of time, but please do submit your questions in the chat box. We'll be taking them mostly at the end, but depending on what the topic is, we'll include it as the presentation goes up to Stephanie. So do get your questions ready. Sorry, Stephanie, it's all yours now.
Absolutely, no, definitely. Feel free to put questions in the chat box or just raise your hand to ask. So we'll do an overview of what we're going to cover today. We'll go over the W's, 5 W's of convertible securities, what they are, when to use them, why to use them. We'll focus primarily on convertible notes and on safes. So the basic terms, what's negotiable, what's standard. We'll go through a little bit of conversion math, how you figure out what it looks like when these convertible instruments convert into equity. And then based on some questions received in advance of this session, we'll talk a little bit about fundraising strategy. Is it okay to do multiple rounds of convertibles? How much should you raise? When do you do a safe round versus an equity round, etc.? So with that said, let me dive right in. What is a convertible security? So it's a security that converts into equity upon some triggering event. And typically that is the company doing a larger equity financing. Equity, of course, represents an ownership interest in the company. These convertible securities are not ownership interests in the company initially, but they will convert into that equity at the triggering event. Two main types. The first is debt, and that convertible note would fall under the debt heading. And the second type is a contract. We'll talk a lot about safes, but there's also instruments called KISS and a few other contractual convertible securities. So when to do a convertible security round? Two main types. Initially, and the type that we'll talk about primarily today is when a company is in the earliest stages of fundraising. So the company has formed, there's a corporation or other entity that's created, and the company has investors that are ready to invest, but they're not quite ready to do a full-on equity round. it is cheaper and easier and more straightforward to do a convertible round at that stage. The other time when you see convertible instruments is in between rounds. So a company that has, say, done a Series A financing and is working on hitting the milestones that it needs to get to a Series B financing and needs just a little bit of extra cash to get there. So those are often called bridge rounds. It's a bridge from the A round to the B round, or from the B round to the C round. That's the more sort of historical, traditional type of convertible rounds. But I would say in the last 5 years or so, that's been eclipsed by the frequency of seeing convertibles for very early stage financing. Why are companies doing convertible rounds in these early stages? It's fairly inexpensive, it's pretty straightforward, and it avoids the need to price the round or to put a valuation on the company. Although, as we'll get into, there's this concept called a cap, which is really a backdoor way of valuing the company. Let's talk about what the alternative is. So when I say on the previous slide, it's cheaper, it's easier. Cheaper and easier than what? So then doing a full-on preferred stock equity round, which is a, let's say, Series C round or Series A round or Series B round. When you do a convertible, you have very few terms to negotiate. We'll talk about what those are on the next few slides. But when you do an equity round, there's significantly more terms to negotiate. You know, with a convertible, you may have 4 or 5 things that you're negotiating on. With an equity round, there's going to be 20 or 30. The convertible itself is a short, maybe 4 to 6 page document, single document. When you do an equity round, you'll often have multiple documents that are 20 or more pages long. There's very highly standardized forms for the SAFE in particular. They have been created by Y Combinator. They're freely available on the website, and there's not much change needed to the forms. Whereas when you do an equity round, although there are forms out there put out by the National Venture Capital Association, or NVCA, those are much more complicated and require a lot more work to get them from the form to a final document. Doing convertibles is a lot cheaper. Lawyers like me, frankly, don't come cheap. And doing a SAFE when you're negotiating one 5-page document is going to be a few $1,000s in legal fees. A full-on equity round is going to be tens of thousands of dollars of legal fees. Convertibles also don't involve any state filing fees, whereas an equity round would. You're also giving away a lot less when you do a convertible round. The investors are going to get fewer rights and have fewer control levers on your company. So there's often very few investor rights, if any. Maybe they'll get some information rights or the right to participate in future rounds. But when you do an equity round, there's statutory rights that they get under Delaware law, or the law of where you're incorporated. And the investors will typically negotiate for certain other rights, veto rights over certain key transactions, registration rights, rights of first refusal, participation rights, etc. It's also lower risk to do a convertible. When you do a full equity round, you're going to make statements about the company called reps and warranties. It's usually 20 pages worth of statements, factual statements about the company. And if any of them turn out not to be true, the investors could sue the company. With a SAFE, you're making 1 or 2 of these statements, so it's much less risky from that perspective. So let's turn to the basic terms of convertible notes. First, you have the principal amount of the note, so the amount that the investor is investing. You have an interest rate, which typically is between 4 and 6%. Sometimes you'll see it lower. I've seen it go as high as 8 to 10%, but 4 to 6 has really been market standard for many years. I haven't seen this change very much in the shouldn't say post-COVID world, in the COVID world. It's staying pretty constant. There's a maturity date, so when does the note come due? And that's typically 12 to 24 months, and that's determined based on when the company expects to do its full-on equity round of financing. You want the maturity date to be slightly after when the company expects to raise its round. You can negotiate over the conversion trigger. So as we mentioned earlier, the note will convert into equity when the company does its next equity financing. but often there's a minimum size. So the note will say, the next time the company does a financing at which it raises at least $5 million, the notes will convert. And that way, if the company is only raising $1 million or $1, the notes will remain outstanding. They won't convert. One of the key terms is the conversion price. So when these notes do convert into equity, typically they're converting at a lower price than the new investors are paying. And that's to compensate these investors for investing earlier when the company is more risky. There's two ways of getting that reduced price. One is a discount rate. So the note will convert at a 20% discount to the new price. So if the new price is $1, the notes will convert at a cost of 80 cents per share. 20%, by the way, is also highly market standard. Very rarely see anything deviating from that 20%. Maybe 15, maybe 25, depending on company circumstances. But 20 is definitely average, mode, median, all the most typical. The other way of getting a discounted conversion price is what's called a cap. So a cap we'll get into a little bit more later, but you pretty much say, regardless of what the valuation is at the next round, the notes will convert as if the valuation were X. That amount is company dependent. There's no market standard because it's based on what you think the value of the company actually is. And we'll get into the conversion math a little bit later so you can see more how this cap concept works. So the original purpose of a cap was for protection if the company's value significantly increases in between the note round and the equity round. So let's take a situation where the company is doing fantastically well. Maybe when the note holders invest, it's still small and early stages and high risk. But by the time the company gets to its Series A financing, it has done incredibly well. It has customers, it has a product. The value is way higher than anyone ever thought it would be at the time of the note round. And let's say the company note has a 20% discount. If you thought the valuation at conversion was going to be, I don't know, $5 million, and it turns out that the company is doing amazingly well and it's $20 million, well, that's a huge difference. That you thought you would have invested 5, even at a 20% discount to the $20 million. It's still a $16 million valuation. So the note ends up converting at a much higher price than the investors or the company ever anticipated. So to solve that problem, this concept of caps came into play. It was supposed to be a very sort of high umbrella valuation that if the company does incredibly well and gets above X value, then we're not just going to have the discount. We're going to have a bigger discount based on this cap. That was the original intent. I never see caps used that way anymore. Almost always when you see a cap these days, it is a proxy for the current value. And it's a way for investors to put a value on the company without doing an equity round. This could cause a problem in that when you're using a cap, you may end up with a conversion price that is significantly lower than the new money price. So if the new investors are paying $1 per share, the cap might kick in and the notes would convert at 50 cents a share. So now you have these investors paying 50 cents a share. But as you may know, with preferred stock, there's often a liquidation preference, meaning that the preferred stock will get paid back at least what they invested before the common holders, the founders, get anything on a sale of the company. So you could have these people, these note holders, paying 50 cents a share, and then they get stock that carries a liquidation preference of $1 a share. And that doesn't really feel fair, that they would get back not just what they put in, but double what they put in before the founders get anything. So the solution to this problem is a concept called shadow preferred, where when the notes convert, they will convert into preferred stock that's identical to the preferred stock that the new holders are getting, except all of the price-based terms are going to be based on the actual conversion price, not the new money price. So you'll end up with 2 series of preferred, one being bought by the new investors at $1 a share with $1 a share liquidation preference, and one that the notes or safes convert into at 50 cents a share with a 50 cent a share liquidation preference. So with notes, there's a negotiation as to whether you go with the default where the note converts into the same securities that all the new investors get, or whether the note converts into this shadow preferred concept. This is a little bit nuanced, so definitely if you have questions on that, feel free to put them in the chat and we can come back to it. So treatment of notes at certain key events. So as we mentioned, the whole point of a convertible note is that when you do a qualified financing, you do an equity financing, preferred stock financing, raising a minimum amount of capital, the note will convert. You can also think about what happens at maturity. So let's say you have a 12-month maturity on your note, and the company gets to 12 months and has not yet done a qualified financing. So the notes have not converted. What happens? If the note is silent, then it's a note, it's debt, right? It's debt and it has a maturity date. And at the maturity date, the note comes due and must be paid back. However, really, nobody ever intends for these notes to be paid back. Investors are not investing in a company via a note with the expectation of getting their money back plus interest. They want equity in the company. It's really an advance on equity. So often you'll see investors and companies negotiate for some sort of conversion at maturity at some fixed price. Another key event is if the company gets sold while the notes are outstanding before there's a qualified financing. What happens then? So again, when you think of these as a typical note, a typical debt instrument, then they stay outstanding as debt in the hands of the buyer, and the buyer now has the obligation to pay them back at maturity. But again, that's not what investors expect. So you will often see a negotiation that the notes will convert on a sale, either at some fixed price or at the price that the acquirer is paying or some discount to that price. Or you will see a repayment with a premium. So maybe the notes will get repaid at 1.5x the principal or 2x the principal. So these are all terms that can be negotiated when you're working with investors to come up with the terms of the note. So then let's turn to safes. So when do you use safes? Really the same stage as a convertible note. I'm not really seeing safes as this bridge instrument. Safes really are this very early stage, first round of financing. Why use a safe as opposed to a convertible note? So it's to align the security with the idea that this is equity in waiting and not really debt. As I said, nobody's expecting to get paid back. It's not real debt, even though it's structured as debt. And the safes say, let's not even pretend that it's debt. Let's just treat it as a contract and call it what it is, equity in waiting. Because it's no longer debt, there's no maturity date, so the company doesn't have to worry about ever paying back the safes. There's no interest rate, that it's just the principal that will convert into equity, which makes things so much easier. You know, when you're about to do your financing and interest is accruing every day, the number of shares that are going to be issued on conversion of the notes changes every day. So if your closing gets pushed back one day, then it's more shares. And it just gets very complicated to manage that. So eliminating interest is a lot simpler. And the purpose of the safe was to simplify and standardize terms. So for the notes, every law firm has its own form safe that it likes to use, and they're all slightly different. The terms that you're negotiating are the same, but the way that it's put into words can differ. With a safe, Y Combinator put out these form safes on their website, and their intention was that you would fill in a few blanks with the terms that are applicable to your company, and that's it. You're not negotiating over the rest of the language. It's the same for many, many companies, same for many investors, so it's a lot simpler. Everybody knows how they work. So the key terms of a safe, very similar to a note. You have a principal amount. As I mentioned, there's no interest. There's no maturity date. In the Y Combinator form, there's no minimum size of qualified financing. The safes will convert when the company does a preferred stock financing, regardless of the size. The conversion price, so again, it's at a lower price than the new investors are paying, either via a discount or a cap or both. So Y Combinator puts out 4 flavors of the safe: discount no cap, cap no discount, cap and discount, or neither. Again, you can talk about what type of securities are received upon conversion. And with safes, they've standardized this to say it's all this shadow preferred. It's the series of preferred where the liquidation preference matches the price that the conversion price. And then treatment on a sale. So again, your options are to get your money back, maybe at some premium, or to convert at a cap or at some discount to the sale price. If folks can just stay on mute, that would be great. Other terms involved in a safe, you might sometimes see investors negotiate for pro rata rights. They're sometimes called participation rights or preemptive rights. It's the right to invest in future financing rounds of the company. You may see information rights. You may see some reps and warranties, so statements about the company. There may be some other documents. So with a safe, there's not typically another document. With a note, you sometimes see a note purchase agreement as well as the note itself. It's not required. It really depends on, frankly, the lawyer's preference when putting these documents together. But these are all other terms for safes or for notes that may be negotiated when you're starting to talk with your investors. All right. Let me take a minute and talk about some conversion math. So how does it actually work when these safes or notes are converting into equity? So let's take a sample company, Nuco, that has 10 million shares outstanding and held by the founders. They've sold $1 million in safes. The safes have a 20% discount and they have a $5 million cap. The company goes to do its equity round and it's given the new investors in the equity round say that the company is worth $10 million. So for the new investors, their price is calculated as the company's pre-money valuation divided by the company capitalization, the shares outstanding. So in this case, it's $10 million divided by 10 million shares. So the new investors are paying $1 a share. How does that work with the safe? So let's take the discount price first. It is a 20% discount, which means a 20% discount to that $1 a share price paid by the new investors. So the discount price would be 80 cents a share. The capped price is calculated based on, so in the prior slide, it was the pre-money valuation for the round divided by company capitalization. Here, it's the valuation cap divided by company capitalization. So you see the valuation cap, even though we're calling it a cap, it's not that cap, protect the company in an upside scenario concept. It is really what we want the company's value to be at the time we convert. So the valuation cap is $5 million. We have 10 million shares outstanding. So the capped price would be 50 cents. And then the safe says that the investors get the better of those two, the lower price of the discount or the cap. In this case, 50 cents is lower than 80 cents. So the safe would convert at 50 cents a share, which is a 50% discount to the price paid by new investors. So for these safe investors getting in early, investing when the company is riskier, maybe has a lower valuation, they end up with a 50% discount compared to what these newer, later investors are getting. I saw a few questions about the concept of pre-money versus post-money safes. So when Y Combinator first put out this safe a few years back, it was what they're now referring to as a pre-money safe. They updated the form about a year and a half ago and are now calling it a post-money safe. So I want to cover briefly what the difference is between those two and what changed and how it matters to you as founders. So the difference is whether the cap is the value of the company before any safes are sold. That's the pre-money concept, pre any safes, any money coming in the form of safes, or the value after selling all the safes, post-money, after the money is in. Again, recall that the conversion price is the cap divided by the company capitalization. In a pre-money safe, company capitalization excludes the safes. It just includes the outstanding stock, and if the company has an option pool. In a post-money safe, the definition of company capitalization includes the stock and option pool and any safes that are sold. So as you can see, in a post-money safe, company capitalization, the denominator, is a bigger number, which results in a lower price. So post-money safe is, all else being equal, more favorable to the investors. I'm just going to pause there and let you look at this, because I know this sometimes takes repeating it a few times to get through, and happy again to take questions on this. One of the benefits of the post-money safe is that it allows an investor to calculate their percentage ownership when the safe converts, regardless of how many other safes the company sells. So with a pre-money safe, an investor's ownership is going to be their investment divided by the outstanding stock and the option pool, plus all other investment. Whereas with a post-money safe, it's just your investment divided by the outstanding stock. So with post-money, you can figure out what percentage of the company you're going to hold after all the safes convert, regardless of what else the company does. And to put numbers on this, let's say you're investing $1 million and the company's value is $5 million, and you're the only investor. So with the pre-money, it would be $1 million, your investment, divided by 5 million plus 1 million. So 1 out of 6, which is 16%. If it were calculated on a post-money basis, it's just your investment over the outstanding stock. So 1 out of 5, or 20%. Post-money safe, in effect, penalizes the company for selling additional safes. Because if the cap stays the same, let's say $5 million, each time the company sells another safe, it reduces the value of the outstanding stock, because outstanding stock plus all the safes stays constant. So the more safes you sell, the less the common stock is worth. A pre-money safe results in investors getting a smaller percentage of the company as the company sells more safes, because their interest is being diluted by additional fundraising, just like it would with equity. Because of that, the post-money calculation, the post-money safes are more investor favorable. And Y Combinator knew this, the drafters knew this, and they made some other changes to the safe that were more company favorable to minimize these negative effects. The goal was not to harm the common holders at the expense of the investors. The goal was to make it simpler to do all of this math, simpler to figure out the conversion price, simpler to figure out your percentage ownership. And there are some changes that they made to the conversion mechanism that are meant to somewhat counteract these effects. You're almost always only seeing post-money safes these days. That's the form that's on the website. Any new companies, that's what they're downloading. And it means that companies need to be very thoughtful about what the cap is and how much they plan to sell. Let me stop there and ask for any questions on the stuff that I've covered so far. After this, I'm going to turn to fundraising strategy. So how many rounds you should raise, can they be at different caps, those sorts of things. So let me stop on all of this safe versus note, pre-money versus post-money, conversion math, and take a few questions on this topic.
Before we take some questions, people have been asking whether the slides that you're presenting will be available.
Sure, yeah, I'd be happy. I can send them to Regina, I guess, and you can forward them to anyone who asks for them. Yeah, I would be happy to share these.
That would be great. So if folks want to ask questions on this section. Okay. So from Laura Halligan, are these terms used for family and friend rounds?
Sure, they definitely can be. I think these are the simplest structures to use for any sort of early stage financing. So absolutely, you can use them for family and friend rounds. You can use them for institutional investor rounds. They're very adaptable.
Great. We have one that was earlier. Let's see, would you get back to shadow preferred with an example of how this would be done to prevent seed 1 from having a liquidation preference over seed 2? That's a great
Sure.
question.
So let's go back to, so let's say seed 1 is the safes and seed 2 is the new money. If the company is doing a seed round, and that's what triggers conversion. So the new money, the seed 2, people are paying $1 a share, and they're getting a liquidation preference of $1 a share. Seed 1,
Right.
the conversion price is 50 cents a share. So in effect, people are paying 50 cents a share. So the liquidation preference would be 50 cents a share. If you didn't do this concept, if you just had everybody the same, the safe holders would be paying 50 cents a share, but getting a liquidation preference of $1 a share. So they're getting this extra benefit. It's in fact a 2x liquidation preference, which is unheard of for an equity round. So why should a safe holder be getting that? So you have this safe 1 and safe 2 that otherwise are identical. They have the same rights. They vote together on everything. They have the same protective provisions. Usually they're treated as one big class of Series Seed. The only difference is in the liquidation preference and anything else that's based on the price. So anti-dilution protection, for example, or if there are specified dividends that are 6% of the purchase price. Anything price-based will be based on this 50 cents a share price. The liquidation preferences will be pari passu, so the seed 1 and seed 2 will get paid back at the same time. It's just that each person will only get back what they put in. The note and safe holders won't get anything more than that.
So we have another question from Juju. Good to see you again. I mean, virtually see you again. What she is asking is, how difficult would it be to negotiate for pre-money safes in an early round? Do investors currently expect post-money safes?
Investors do expect post-money safes. You can certainly negotiate for a pre-money safe. One of the problems, and this seems like it should be a very easily surmountable problem, but Y Combinator pulled the pre-money forms down from their website. Only the post-money forms are on their website. So just getting a hold of those older forms is not always easy to do. But if you're working with a lawyer, I assume most law firms have saved every version of the safe as mine has. I think it's going to be a harder negotiation just because post-money has become so market. I think if you are forced to do post-money, you can mitigate it by just making sure that your valuation cap is higher than it would have been if you were doing pre-money, right? So if you plan on raising $2 million in safes, let's say you would have done a pre-money safe with a cap of 5 million. If you're doing a post-money safe, you better make that cap 7 million. Right? Because it's supposed to encompass everything that the company was worth by itself and any money that you've raised. So all of this is, when I talk about pre-money versus post-money, it's all else being equal, right? The cap being the same. But for the same company, the cap should not be the same between a pre-money safe and a post-money safe. It should be higher by the amount that you expect to raise in a post-money safe.
Wow. Gerard says, you're great. And thank you very much. Another question from Warren. Is there a range of discount prices that get negotiated? Standard is 20%. What are the high lows that you see?
So I almost always see 20%. The only time that I see it deviating is if there's a very specific, unique reason. For example, if the company plans to do their financing in 2 months or 3 months, but for whatever reason can't do it right now, and they just need a little bit of cash to get them through the next few months, then maybe the discount would be lower. Because the whole purpose of the discount is to compensate investors for the risk of investing in an earlier, riskier, lower value stage. But if you know you're closing your round very, very soon, maybe you'll have a smaller discount. Okay. You will see a higher discount if not in a typical early stage, first round. I can't think of any reasons why a typical startup company doing a SAFE as its first round of financing would deviate.
Right.
If, however, you're in that bridge round situation, like you've done an A, you're trying to get to your B, and the company is really not doing well, and it's really risky, and they may never even get to the B, maybe the investors will demand a higher discount price to compensate for that risk.
Mm-hmm.
The other thing about the 20% discount is now that caps are really almost universal, the discount price is almost irrelevant because it is so much more likely that the cap price will result in a bigger discount than the discount price. So the discount is sort of just a, baseline in case the cap was set too high or the value of the company at the financing is low compared to the cap. But it rarely comes into play.
That's really terrific. And Jujube also thanks you for your great insights. We're now moving ahead in terms of the time allotted. Do you want to pick up now, Stephanie?
Sure.
Whatever questions
Yeah, and I just
are
have
out
two
there.
more.
Right.
Yeah, I just have two more slides, so I'll cover these because I know there were some questions. And wow, that time went fast. So somebody asked about raising multiple rounds and if it's possible to raise multiple rounds at different terms. Is it possible? Sure. In order to do this, a company just needs approval from its board. Typically, with an early stage company, the board is just the founders. So if they decide to do it, they can do it. However, with my advice, I would say the simpler the better. So there's definitely some challenges that you face when you have multiple rounds of convertibles at multiple different prices. You can end up with multiple series of shadow preferred. So if you have different caps, there's different conversion prices for each series, and you'll end up with seed 1, seed 2, seed 3, seed 4, and it just gets complex and could inadvertently give folks rights that you didn't intend to give them. There's some rights under Delaware law where each series of preferred has certain protections. The more series you have, the more protections you're giving. The calculations can get very tricky for figuring out what the conversion price is and what's included in the pre and what's not, and just the cap table math gets very complex. There can be unintended consequences. So I had a deal that closed about a month ago where the company first did a friends and family round using notes, $7 million cap, 20% discount. They then went ahead and did a SAFE round, $7 million cap, 20% discount, same terms. Then they did a SAFE round at a $10 million cap, 20% discount. Well, because of how the note was worded versus how the SAFE was worded, even though the company thought they were selling the same thing, 7 million cap, 20% discount, the notes ended up converting at 77 cents. The SAFEs were at $1.13 and the new money was at $1.60. And that's because the notes said the way you calculate the conversion price is by using the same methodology that you use for the new money, but with a 7 million cap. Whereas the SAFE said the way you calculate it is by doing 7 million cap divided by the pre-money valuation, by the pre-money capitalization. So even though they looked the same on their face, it ended up being a huge difference in value. So if that's less of an issue if you have multiple rounds of SAFEs, but if you're doing notes and SAFEs, they may convert differently, and you need to be aware of that. And as we talked about with a post-money SAFE, the more SAFEs you sell, the lower the percentage of the company that the common will hold. So can you do it? Sure. Do I see it all the time where a company will do a friends and family round at a 2 million cap and then do a little better and get some money from an angel at a 5 million cap and then get some institutional at a 10 million cap? Sure. Is it better to just do one SAFE round and then get to your equity financing? Yes. If you can, not always possible. Folks had asked about how much to raise. Right. So the right answer there is whatever you need to get you to your next inflection point to raise your next round. But be thoughtful about the size of your convertible round versus the anticipated size of your equity round. The lead investor in your equity round is likely going to want the new money to represent a majority of the round. So I wouldn't sell $3 million in SAFEs if you're only going to do a $2 million equity round or a $3 million equity round. You want the SAFE round to be, I don't know, a third-ish of the total money raised, because anything beyond that, the new investors will not be able to get the percentage of the company that they want for the investment that they want to make. You should also think about your qualified financing threshold. So this is the size of the financing that triggers conversion. You'll want to make sure that you're planning to raise more than your qualified financing threshold, so that if your deal gets downsized a little bit, the notes will still convert. And you want to compare the size of your fundraise to what you think the qualified financing would be, again, to make sure that the new money, the qualified financing, is larger than your safe round. So that's all I have prepared. I'm happy to take a few more questions with the rest of the time that we have. And if you have other questions that I haven't covered here, you can feel free to email me. My email address is on the screen, and I would be happy to take questions on a one-off basis if there's something we didn't cover or a situation that's specific to you and that you don't want to raise with the whole group.
That was terrific, Stephanie. Really, I know that everyone is waiting to get an email from me with your slides. So
I'll send them right after we log off.
and it'll be sent out soon after. So I have a whole slew of questions in front of me. If folks have questions for this segment or earlier topics that we've covered in the seminar, do put it in the chat now. But a couple of questions that I have in front of me. Has COVID-19 changed any of this or all of this? And
surprisingly, it really hasn't. I mean, I think some of it is company specific, right? Like a cap, I can't tell you what's market rate for a cap because it's based on the company's specific situation. So have caps gone down? Have valuations gone down?
Yep.
Honestly, I haven't really heard that much. I wouldn't be surprised if it were happening, but it's not something I've really seen. I think everything sort of got put on hold back in March and April when nobody knew how long this was going to last and how is it going to affect the economy. By now, things really seem back to normal. Investors have money that they want to deploy, and maybe even more than they normally would at this time of year because they did put a pause in the late spring, and deal making is always slower in the summer. I haven't seen terms changing, discount rates. So no, surprisingly, I have not seen much of a COVID impact at all.
well, that's actually good news.
I will say the one thing, and
Yep.
this is all, it's sort of pre-getting to what's on the slides, but it's harder to make connections with the investors. It's harder to pitch investors when you're all remote. It's harder to network. So getting to the point where you have an investor who wants to invest and you're negotiating terms, that is taking longer. That is a little bit harder. But once you get there, I haven't seen very much changing with the terms themselves.
Yeah, and what you said about access to the investors, that has been a theme in our investor series. It's just hard. And, you know, everybody wants to be available, but it's just different times. And people, as you and I were talking offline, it's Zoom fatigue over and above, right? You know, Ben just came in with a pretty great question because he's asking the shift here. He's asking, could you repeat the advantages and disadvantages between convertible notes and SAFE from an investor's perspective?
So I think the main advantage from an investor's perspective is the standardization. You know what you're getting, you know how it's going to convert. It's the same as all your other companies that you've invested in using SAFEs. Really, you can set up SAFEs and notes to be exactly the same in terms of terms, what they convert, what price they convert at, what they convert into. So it's just a question of the paper that you're working with, and the standardization of the SAFE has been huge.
Wow, that's great. Any questions from the, oh, here we are. Good to see you too, Juju. Thank you so much for your note. Her question is, when incorporating a company, founders are asked to value their startup. Really great. If the startup has not started generating revenue at that point, what is the best way to value it? Good question.
It's a great question.
Really
And
is.
it's a hard question to answer because there is no, you know, independent third party way. There's no mathematical way. it's really just a negotiation between you and the investor, and it's in your interest as a founder to get the value as high as possible. And the investors, of course, would want it as low as possible because it's all about, on conversion, what percentage of the company each one holds. You're not really going to be able to look at your, model and say, oh yeah, our, like new net present, value of your expected revenue. Like none of that really works in the early stages. So it's really, think about it in terms of ownership percentage, and based on the amount that the investors are putting in, what percent of the company do you think it's reasonable for them to own? And you could back into a valuation that way. But really, it's a question of negotiating power, frankly.
So what's the biggest mistake that people make with regards to safes and convertible notes?
So the things that come back to bite people, I would say setting the valuation too low can really, really hurt founder ownership after you do your first equity round. So, in the old days, pre all of this stuff coming into play, when you would just start with an investor in an equity round, company would maybe sell 30% to the investors at an A round. But if you're doing all of these safes at lower valuations, you could easily end up with a situation where after your first round of financing, founders hold less than a majority of the company. And that's not really a position that you want to be in. You've just given away too much too cheaply. And I think people don't realize how much the caps come into play when doing that, and how much of a discount the safe holders get, and how it really ends up hurting the common holders. New investors will often come in and say, you have all these safes, you have all these notes. You know what, the company, I'm going to give you a 10 million pre, including all of this after conversion of all the safes and notes, right? So all of that then goes into the pre, and it ends up diminishing founder ownership. The other thing I would say is what I talked about with multiple rounds, like just, doing round after round after round after round gets complicated, and it I think looks a little bad. It looks like you're not able to get to that big equity financing milestone. So I would say try to raise one round with as much money as you need to get to your first equity round, and try to stick to that if at all possible.
Well, that is really great advice. Sometimes emotions get mixed in and it's hard to follow, but really, really great advice. So I don't see any more questions coming in, and being respectful of everybody's time, I want to thank you, Stephanie. This was really terrific. And I know that there'll be lots of questions coming my way and your way about this presentation, because you covered a lot and gave us a lot to think about. So as promised, we'll get the slides to folks. And again, thank you so much. And don't forget, folks, she has another session coming up in a couple of weeks, and don't miss out. What we're seeing in the chat box is lots of people thanking you. And particularly, I love this, refreshingly practical and clear advice. Thanks. So I think that really caps it, to tell you the truth. This is a very complicated topic. It can be a minefield for the startups as well as the investors in many ways. And you've really cleared the path for many of us in this seminar. So thank you so much.
You're welcome. Thanks everybody for coming. I appreciate your attention. I hope it was helpful. And again, feel free to reach out if other questions come up.